Okay, chapter 1. So we're actually, this is going to be a little bit abstract, meaning not a lot of great examples, but before we start, I want you guys to put aside any notions you have about corporate social responsibility, about not-for-profits, about your political ideologies. The sole purpose for the vast majority of businesses in the world is to make money, to make a profit, right? So that's the sort of hat I want you to wear when you're in this course. It's very much, how much money are we making? How do we make more? How are we comparing to other companies in the same business as us so we can compete with them to make more money? If you have given money to a company, and we'll go more in more detail than that, the vast majority of people in pharmacy don't care about if they're polluting the environment or not. They just care about how much profit they make. So that is the lens through which we view accounting information, okay? So that should serve as the backdrop here. Everyone's goal is, in finance and business, is to make more money. So the reason why financial statements are so important is because it's like your scorecard, right? It shows how much money you've made. The other thing is we're going to start a company. And this is going to be our example company throughout the term. It's called ePhone. They design, manufacture, and retail high-end smartphones. Okay, and those words are important. Design, manufacture, and retail. They're important because each of those activities involves different processes, right? To design, you need a bunch of highly paid engineers in California and some nice office space. To manufacture, you need a physical facility, right? You need workers on the floor putting together components. To retail, you need a storefront. You need to carry inventory. So all of that is very important. So we'll get to that. But you'll see ePhone a lot here. No relation to any other companies in existence. Okay, so understanding the business. So what on earth, how does the business work? All businesses report, so first of all, let me just get this. All businesses have managers. And these are the people who manage the business. So they are responsible for the day-to-day operations, right? They say what to buy, what to sell, what prices to set at, where to open a new store, where to close an old store, how much inventory to carry, all that. All these decisions, all these business decisions are made by the manager. Okay? So the managers run the business operations. They will purchase materials and labor, meaning if you're going to manufacture phones, yeah, you need the screens, you need the cases, you need the chips, but you also need people, right, to put those together, to oversee it. You need to physically manufacture the product. So you need to take these raw materials and these people and somehow combine them to get a finished good. You need to manage selling products to customers. How do you ship it to them? How much do you charge them? And you need to collect cash from your customers and pay your creditors. A creditor is someone to whom you owe money. If you buy a bunch of screens and cases, you tell the supplier, hey, I don't have any cash right now, but I'll pay you for these screens and cases when I sell the phones, right? So it's a cycle. You can't pay your supplier until you get paid by your customers, okay? So what's going on up here? Investors and creditors. Investors and creditors give money to the company. The managers then use that money in the business operations, okay? If you're the owner of a business, an investor, you're not the manager. There's two different things, right? Business owners usually hire managers to run the day-to-day. All of us can actually be investors and business owners. If you have $1,000 of spare cash, you could open a Questrade account tomorrow and go buy $1,000 of Google stock. You're an investor. You certainly have no say in the management of the business, nor would you want to, because you're sort of passive, right? You have your school to focus on. So the question is, why on earth would you lend money to anybody or invest in a company if you're not going to make more money, right? Again, we're thinking like capitalists here. All we care about is making more money. How do we turn $1,000 into $2,000? So there's two ways, if you buy Google stock, there's two ways that you can make money. The first is you can sell your shares. And a share is just, I mean, it used to be a physical certificate. And it might have a little logo on here, a little star. And this might be, and there might be millions of these, right? Everyone can have one. You can sell one of these to someone else for more money than you paid for it. If you bought a share of Google at $1,000 and someone tomorrow is willing to pay you $1,200 for it, you've just made $200. Right? So you might buy the share with the expectation that the value of that share will rise in the future. And we'll get to what might drive those expectations later on in the course. But if you're a savvy investor, you might say, oh, I'll get in now. People don't know about Google yet. Think of if you were an investor, even in Apple. When was it? Like 10 years ago when Apple was like a nothing stock, 15 years ago maybe. It was like worthless. And people got in. It skyrocketed, right? People made like 100 times their money, whatever it is. So this happens. The other way to make money is to receive a portion in cash. So rather than selling your ownership interest, if I owned $1,000 worth of shares in Google and I sold them for $1,200 to somebody else, I made my $200 profit, I went and put it in the bank, I'm done. I have no more exposure to Google, right? You might want to retain that share. You might think, well, I think it's actually going to go higher, so I'm going to hold on to it. And Google might every quarter, meaning March, the end of March, the end of June, the end of September, and the end of December, pay out what's called a dividend. And a dividend is a cash payment to the shareholders. And Google will use any excess cash it has. Let's say Google generated $100 million of profit that quarter, and it only needs some of it to reinvest in its operations. They might say, well, we're not using this cash, we'll give it back to you guys, the investors. That's a return for you as well. If Google paid everybody, all of its shareholders, $100 a share, if you invested $1,000, you've now made $100 on top of that investment, right? Your share is still worth $100. Actually, maybe your share is appreciated to $1,200 and you got paid $100. Now you're up $300, right? So those are the two ways an investor can make money, okay? And I mean, without having any accounting knowledge, what sort of properties would you imagine are associated with businesses that you want to invest in? Maybe profit, earning a profit, right? Revenue growth, growing how much, the amount of sales they have every year. Cost cutting, right? Whatever, anything they don't pay out in costs, the company gets to keep, meaning they can pay out as dividends or they can reinvest in the business, right? High growth. Startups are, people like investing in startups because they go from nothing to Uber, right? Revenue growth. What are words you probably heard for companies you don't want to invest in? Debt. Too much debt on the company's balance sheet and they're going bankrupt, right? Or losses instead of profits. In the red, it's called, if you have losses instead of profits. So you already sort of have a sense, probably, of what it means for a business to be doing well as opposed to doing poorly. But all that comes through in the financial statements, right? Okay, so we talked about investors. You buy a share of Google. It's a share of the equity, and we'll get into that detail later. You can sell the share or you can receive dividends. Now, when you invest that money, There are no promises. Google doesn't say, I promise to pay you a dividend. Google doesn't say, I promise to repay you the $1,000 in the future. In fact, if you invest $1,000 in Google and it goes bankrupt tomorrow, too bad, so sad. You were an investor. You took that risk. A creditor is a little bit different. They loan money to companies. And a loan is legally different than an equity investment. We'll get into what equity means, but creditors lend money to a company for a specific length of time. It might be a 1-year loan, a 5-year loan, meaning at the end of that term, the company has to repay the loan. That's different than shares. Shares do not have a specified life. Shares exist indefinitely, and the company never has an obligation to rebuy those shares from you. Okay? So how does a creditor make money? So if you're an investor, your shares of Google can increase and you can receive dividends. That's how you make money. If you're a creditor, if you loan money, the only way for you to make money is to receive interest. So if you were to loan Google $1,000 and say, pay it back to me in a year, would you say, just pay me back $1,000 1 year. I'll just give it to you for the year and then give it back to me, no problem, right? Unless you're a really nice person, you wouldn't do that. That's pretty anti-capitalist, right? Maybe to a friend you would if they needed the money, but for most arm's length transactions, you're not going to give anybody money for free. Interest is the cost of money. You say, I'll give you $1,000 today. You need to give me $1,100 tomorrow. 10% interest. And that's your return. Okay, and we'll get into what drives that later on. But so you make money in two different ways, depending on if you're an investor or a creditor. Okay, what does a supplier do? So, or rather, a manufacturer can either make the parts themselves or they can buy parts from suppliers. So that's interesting to think about. It's called vertical integration. If you think of all the parts that go into your smartphone, Apple doesn't go extract minerals from the earth and make the chip and design the, well, it does design the software, but for Android, like if you make an Android phone like a Samsung, they don't design all the software. Samsung occupies a portion of that spectrum, right? They'll parts needed to make the phone. They'll put it together and they'll add on their own overlay of software and then they'll sell it to you. You can think of what a fully vertically integrated company might be. They would be a resource extractor on one end and a retailer on the other. They go start to finish and they do everything. That's a really bad idea for companies. Do you know how hard it is to manage even Samsung? And they only occupy a small portion of that supply chain. Think of if you had to dig the ground, extract the minerals, process it, make the chips, etc. Right? So you have to understand what portion of the supply chain the business occupies. Okay, the accounting system. So accounting is meant to collect and process all of this transactional information. Everything that's happening in the business is captured by the accounting system. Everything important, that is. And ultimately, we form reports to decision makers. Decision makers can be either internal, so those are the managers who make the day-to-day decisions about the operations. Do we hire more people? Do we fire people? Do we open a new location? What do we charge for our product? Should we enter into a new contract with a supplier? All those decisions, those are internal decision makers. What we're focusing on is the external decision makers. And these are investors and creditors. If we invest in shares of Google, we are external to the company. We have no say in management. They wouldn't give us any information that's not what's called publicly available. You can Google right now and get Google, you can go to Google and Google Google's financial statements, and you'll get a 200-page report. It's publicly available. There's a lot that goes on in Google that's proprietary and private that you as an owner have no access to, unless you own a significant stake. If you own 20%, 25% of the business, all of a sudden you start getting access to that information. But you as a shareholder, you own one of hundreds of millions of shares. You don't get anything. You're just sort of a passive, hands-off investor. So you're external to the business, right? So how does Google communicate with you? Financial statements. How does Google communicate with its bank? If JP Morgan Chase lends it $500 million, it's going to say, give me financial statements every quarter, every 3 months, because we want to make sure you're not going to go bankrupt on us. We want to make sure you're going to pay us the interest, right? If you're a bank, so remember how I said 10% interest, right? Let's say if I'm a bank, Google wants $500 million, JP Morgan Chase says, sure, I'll loan you the money, and you give me back the $500 million plus 10% interest, $50 million. How do they come up with that 10%? That's a very interesting question. Well, it depends on how risky is Google, right? Google is a very safe bet. JP Morgan Chase might say, oh, we'll lend it to you at 3%. You're very low risk. If you're a startup, not Uber, if you're like Uber before they got big, the company could go bankrupt tomorrow. You're going to want 10%, 15%, 20%. Because the probability that you go bankrupt tomorrow is much higher than Google, which, as we saw, has $127 billion of assets. Right? It's not going anywhere anytime soon. So the focus of this course is external decision makers. The formal method of communication is the financial statements to investors and creditors. So that's what I just said. Financial accounting reports go to the external decision makers. These are periodic financial statements, periodic meaning they're released every period, every 3 months, every year. The other form of reports are managerial accounting reports. So these will be internal, okay? And these don't follow standard guidelines. They're internal because managers care about the amount of inventory they have on hand, whereas for the financial statements, you might not really care that much, right? If you're a manager and you need to make sure that you can produce 100 phones, and you know that every phone needs 1 case, 2 chips, a glass screen, you want to make sure you have one of each of those in place, right? So there might be a specialized accounting system that says, here's the quantity of every item you have that goes into producing a phone. As an external decision maker, if you invest in a share of Google stock, you don't really care, nor do you know what you're looking at in the first place. Okay, it'll become easier to understand what the differences are as we move on in the course, but our focus is on the left side here, financial accounting for external decision makers. Okay, so accounting is an organized format used by companies to accumulate the dollar effects of transactions. You'll see what that means hopefully soon. When studying the financial statements, these are some things we care about. What elements or categories of items are reported on each of the 4 statements? Or, better question, what type of information and where can you find it? What are some things you might want to know, as we discussed? Where do I find profit? Where do I find the cash balance? Where do I find how much debt the company has? Where do I find how much revenue the company made? These are things you want to know, and you need to know where to find them in the financial statements. It's like reading like not a book, but like it's a reference document almost. So you need to know what you want and where to find it on the financial statements, okay? What time period does this cover? Again, monthly, quarterly, annual. This is interesting. How are the elements within a statement related? And that's a pretty abstract statement, but we'll get into it. The question is, how does revenue relate to cash? Or how does profit relate to debt? And we'll get into that, but all of the items are actually very interrelated. And why is each element important to managers' decisions, owners' decisions, or creditors' decisions? Or how important is it? Okay, the 4 basic financial statements. So I actually want to qualify this and say 3, because this one is not as important. Okay? The major ones we're going to talk about are the statement of financial position. It's a mouthful. It's also called the balance sheet. And you'll understand why it's called the balance sheet. But it reports the amount of assets. Remember how we saw Google, $127 billion of assets? Liabilities and shareholders' equity. Okay, those are 3 items you will always find on a balance sheet. And that's exactly what we saw. Remember in the very beginning how I said you might not know what these words mean. It was total assets was $127 billion, and total liabilities and shareholders' equity was $127 billion. I was showing you Google's statement of financial position. It shows it at a point in time. What is a point in time compared to a period of time? A point in time is 7:55 on May 1st, 2017. Immediately, right now. How much cash do you have in the bank? Not how much cash did you have yesterday, not how much cash will you have tomorrow. How much cash is in the bank today? What is the value of inventory on hand today? What is the amount of debt you owe today? A snapshot. When you get your credit card bill, it shows the transactions, but it says you owe $1,000. Your balance owing today is $1,000. If you go to your bank account, you see $2,000. That is the balance today, right? So the point in time is very important. And this is assets, liabilities, and don't worry, we'll get into all the definitions, and shareholders' equity. The second statement is the statement of comprehensive income. Again, big words. We're just going to, you can also call this the income statement. And this shows the revenue less the expenses. We haven't got into accounting yet. If I asked you, if I have $100 of revenue and I have $40 of expenses, what's my profit? $60. That's it. That's as complex as the math we're going to be doing in this course. You already know, fundamentally, you all knew that if it costs you $40 to make $100, your profit is $60, right? If it costs you $120 to make $100 of revenue, you're losing money. You're losing $20 every period, every transaction, whatever it is. Probably not a good business to be in, right? You know that fundamentally without knowing anything about accounting. It's just how you reflect those numbers, okay? How we show these. So revenue and expenses accumulate over time, okay? We might look at a period of 6 months or a period of a year. If I asked, when people talk about how much money they make, they don't state it typically on a daily basis. They state it on an hourly basis or an annual basis. You might say, I make $25 an hour, or I make $50,000 a year. That means after 1 year, you expect to earn $50,000. You don't say today, I mean, you might say today I made $100, but that's not as meaningful, right? You care about the accumulation of revenue over a period of time. Same for expenses. Those expenses accumulate over a period of time. Notice how this is different than the statement of financial position, the balance sheet, which is what is the balance today? How much cash do you have today? How much debt do you have today? So again, statement of comprehensive income over, not sure why I did that, sorry, overtime. Not overtime like you get paid overtime, but over a period of time. Statement changes in equity, we'll get to that. It's not that important. It's more what I would call a subsidiary financial statement. It's like a supplementary, sort of shows you some numbers, but really not that important to a fundamental understanding of accounting. And the third statement is the statement of cash flows. Now this is an interesting one, and we'll get into this. It's probably the most complicated statement to understand, but if you said you made $50,000 this year and you had expenses, let's say living costs of $10,000 this year, you'd say my profit this year was $40,000. What if of that $50,000, let's say $25,000 was still owed to you? Let's say you'd done work for somebody and they said, oh, I'll pay you in 6 months. And you thought they were good for it, okay, but you haven't yet received the cash. So if I looked at your bank account, based on the information you told me first, where you earned $50,000, cost you $10,000 to make it, I would expect to see $40,000 of cash in your account. But if I looked at your bank account and saw $15,000, I'd say, well, where's the other $25,000? You'd say, oh, well, it's still coming. I've earned it, I've done the work, the guy's going to pay me, but I haven't yet received it in cash. The income statement will show the first number that I talked about. The income statement will show $40,000 of profit. You've done the work, you've incurred the expenses, you've economically earned a profit of $40,000. The cash flow statement will say you only earned $15,000 because you haven't yet received the cash. The cash flow statement shows your cash balance at the very beginning of the year, January 1st, and it shows every transaction that occurred in cash to get to what the cash balance is in your bank account today. And there's a method of doing it. It just doesn't go list every bank transaction, because you imagine if you're Google, you have 1 million transactions a day. That wouldn't be very reasonable to look through. So there's a way of doing it to report it in one page that shows here's the balance in our bank last year, and here's all the activity that occurred, and here's the balance in our bank today. Different than the amount of profit you earn. Okay, and we'll get into those nuances. One thing to note is the statement of cash flows is also over time. So where I might say the statement of financial position will show you the amount of cash you have today, the statement of cash flows will show you how much cash you had last year and how you got to the amount of cash you had today. It'll be, if you guys run a budget for yourself, you say, well, I'm getting $5,000 in OSAP, I have to pay my tuition fees, I go out to eat once a week, I have to buy groceries. You're kind of going to run a little budget, right, for how much cash you expect to have at the end of every month or every year, right? It's the exact same thing, just on a business scale. Okay, so on the statement of financial position, these are some typical account titles you will see. We'll go into the definitions of the important ones, so don't worry if you don't understand what these words mean. But in the assets, you'll see cash, right? You'll see land and equipment. If you own a car, that's an asset, certainly. Let me ask you, what do you think the definition of an asset is? Yep. Good answer. So I said, what is an asset? And the answer was something that can be liquidized to cash. Something you have in your possession that can be liquidized to cash. I'm going to give a broader definition, and it's going to be, it's anything that's owned that provides future benefit. So it's really broad, but that's how the accounting rules define it. And I think the definition is in here somewhere, so don't worry, you don't have to write that down. But if you think, why is equipment an asset to us? Because it's going to last for a long period of time. Hopefully it's going to last 5 years. Not only will it last 5 years, but we're going to use it. If we're ePhone, what would we use equipment for? We're going to manufacture phones, right? And then we're going to sell those phones. If you have a piece of equipment that is 40 years old and it's completely broken and no one's going to pay you anything for it and it can't be used, is that really an asset? Probably not. It's probably worthless, right? Okay, what are some examples of liabilities? Trade payables. What does that mean? A trade payable is an amount you owe to your supplier. Remember in the beginning I said we might not have enough cash to pay our suppliers until we receive the goods from the supplier, like the case and the screen, put it together, sell it to a customer, receive the cash from the customer, then we can pay our supplier. it's still a liability. As soon as we receive those cases, that shipment of 100 cases from our supplier, we owe them the money. So that's a liability, right? Trade payables. Just like when you go to Yi's Sushi and you pay on your credit card, you still owe the money to Visa just because you haven't paid it yet, just because you haven't got the statement yet. As soon as you ate and paid with your credit card, you're going to owe the money, right? That would show up as a liability on your personal balance sheet. I'm going to some of these other examples later. Shareholders' equity. I also want to go into that later. But something to note, the way this is structured is extremely important. This slide is not a coincidence. And by that I mean assets are on the left and liabilities and equity are on the right. Okay, there's a reason they've been structured in such a way. And this is the fundamentals of the accounting system. This is how transactions and balances are recorded in all of accounting. This goes to the very formal definitions. I would not recommend memorizing these, but understand them. An asset is an economic resource, controlled is an important element, by the entity, from which future economic benefits may be obtained. Future economic benefits refers to revenue and cash. That's what everybody cares about. Ultimately, at the end of the day, everybody just wants to make more money. A future economic benefit here is not defined as more income equality, lower wage gap, better, less carbon emissions. That's not a future economic resource. In accounting, a future economic resource is more profit, more revenue, more cash. A liability is a debt or legal obligation that result from a past business event. So that's an interesting one. And notice how the past business event is up here too. Past business events. That means something has to have occurred in the past for it to be recorded in our accounting system. We don't prospectively record a transaction. We don't say, well, we're planning on buying some equipment a year from now, so let's record that as a purchase today. Well, no transaction occurred. We haven't done anything. We haven't gone out and spent cash. If we entered into an agreement, maybe whereby we said, deliver us the equipment in a year, but I'll pay you today, all of a sudden something's happened. Cash has changed hands. Something has to have happened in the past to lead to a transaction today. The expectation of receiving an asset or incurring a liability in the future does not lead to the recording of a transaction today. Okay? And shareholders' equity is the amount of financing provided by owners of the corporation and from earnings over time. And we're going to get into that definition soon. A little bit doesn't really make sense, but right now it might not make sense to you, but it will, I hope. Okay, remember what I showed you here? How this was on the left, the assets were on the left, and the liabilities and equity were on the right? Not a coincidence. So this is an extremely fundamental equation. You know how Einstein has E equals mc squared? This is that. Assets equals liabilities plus shareholders' equity. If you understand this at a very deep level, if it becomes part of your gray matter in your brain, you can finish the course. You don't need to come to class anymore. Okay? Maybe that's an exaggeration, but this is an extremely fundamental equation. It will always hold. It will always be true. Remember the Google example where we looked at Google's financial statements. The assets were 127 billion. And this portion here, the line called liabilities and shareholders' equity was also 127 billion. Not a coincidence. Okay, so here's why the statement of financial position will always balance. So imagine we're going to start the company ePhone. Let's say we each have $1,000 to spend, And instead of going and investing in Google, we all come together and we say, we have a good business idea, we're going to start ePhone. They're going to design, manufacture, and retail their own smartphones. So what do we have to do to start a business? Well, we have to incorporate it. That's like $200. You go to the Government of Canada website and it can be done in a day. It's no problem. And now we say, okay, so what do we need? We need office space. We have to rent office space. We need manufacturing equipment. We need to pay people. We need a supply network. We need a retail network, right? We need all these things to happen. These things don't happen spontaneously. We need to actively have these things happen. So how on earth are we going to get equipment? ePhone has no money. So how does ePhone get money? There's only 3 ways for ePhone to get money, but when it's a new company with no assets, there's only 2 ways. The only ways for ePhone to get money are for investors to put in money, for us to each put in $1,000 and take back shares, meaning we reach a shareholder, we hold a share, we reach a shareholder of ePhone, or we go to the bank and we say, bank, can you loan us $10,000 so we can buy some equipment? Those are the only ways ePhone can get money. How else, what other way can you imagine ePhone gets money? The third is once the operation gets going, let's say we do a combination. Let's say we go to the bank, we say, bank, give us $10,000, we need some manufacturing equipment. They say, okay, you're kind of risky, but we'll do it, we'll charge you 10% interest. And then we collectively put in $20,000 of equity. Now ePhone has $30,000. Now think about what happened on that day. Sorry, do you have a question? Oh, okay. So I saw something moving. My mistake. On that day, the bank's going to transfer us $10,000 of cash, and we're each going to transfer $20,000 of cash to ePhone, or not each. Collectively, we're going to transfer $20,000 of cash to ePhone. Now ePhone has $30,000 in its bank account. But, so let's use an example here. So assets. So what resources does it have? It has the best economic resource, $30K cash, right? Now, you can think of this 2 ways. One is this equation always must balance, meaning it must be equal on both sides. The other way to look at it is to say, okay, well, liabilities. We owe debt to the bank, right? We took this $10,000 from the bank, but the bank didn't give it to us. We have to repay the bank at some point in the future. So we are going to have a $10,000 liability. We'll call it bank debt. And the remainder is the amount contributed by the shareholders, us, the shareholders' equity. Equity is just a fancy word for the remainder between the value of the assets and the value of the debt. If the assets are worth $30,000 and there's $10,000 of debt, we get whatever is left over. So in this case, ePhone raised $20,000. Now, what's that called? That will actually be called common shares. And this is just a legal term. You're not going to give money to ePhone. You want something in return, right? You need something legal in return, some proof that you own a portion of this company, right? Let's say there's 150 of us. If everyone buys 1 share, we each own 1/150th of the company. That entitles you to dividends over time, and it gives you the right to sell. You can sell this legal security to someone else, right? These are called common shares by law. So ePhone actually gives you a common share. It used to be in the old days you get a physical common share, now it's all virtual. But you would be the rightful owner of a common share. And when you initially invest, it's worth whatever you paid for it. Right? So collectively, the common shares are worth $20,000. If there's 150 of us, we each put in 20,000 divided by 150, whatever that is. Notice how the accounting equation balances. The assets of $30,000 cash are made up of, how did they get there, right? The only way for them to get there is a combination of debt and equity. We took on $10,000 of debt from the bank, and we had shareholders contribute $20,000. Okay. Now, You might be wondering, what is the difference between bank debt and common shares? So equity holders, you can think, this is called pecking order theory in finance, and you can think of it like a waterfall where if the business runs into trouble, who gets paid first? Okay? Your concern as an investor is that your money disappears, right? Your concern is you put in $1,000 today to ePhone, and you just can't sell its phones, no one wants them, the business goes bankrupt, your money's gone, right? That's the biggest concern as an investor. But you also want the upside being, what if ePhone becomes the next Apple, right? What if the shares are worth $1 million each and you only paid $1,000 for them? You just made 1,000 times your money, right? So if the business goes under, if it goes bankrupt, if it can't make enough money to pay its liabilities, it has to liquidate all its assets. The liabilities get paid first. The bank debt gets paid before the equity holders get paid. If there's anything left over after the bank has been paid, then the shareholders get paid. That's a very risky position. Most likely, if a business goes bankrupt, not even the bank debt gets fully paid, meaning the equity holders get nothing. Okay? So you think, well, why don't I just loan the money so I'm secure to ePhone instead of being this equity holder? You're subsidiary. You are subordinate to debt. Debt comes first. You might think, well, why would I want to be an equity holder, right? Well, there's two reasons. One is equity holders collectively control the business. Okay? Collectively, we each get one vote. A vote for what? We get to elect who manages our company. If we don't like the manager, we can kick them out. We might say to the manager, hey, you need to get our approval as shareholders before you make any really big decisions. Before you open a new manufacturing plant, you need to get it by us for our approval. If one of us controls 51% of the votes, you control the company. So creditors, banks never have control. They don't have any, they do have certain levels of, they say things you can and can't do. You can't take on more debt. You have to make sure you earn enough profit every year to repay the loan. But the bank doesn't have true strategic operational control the way equity holders do. The second reason why you'd want to be an equity holder is you have what's called upside. So let's say we invest $30,000 of cash, we go out, we buy some equipment, we make some phones, and we do really well. We overtake Apple's market share. Everyone wants an ePhone, right? And the company skyrockets, and it generates $1 million in cash. How much do we owe the bank? We still only owe them their $10,000 plus interest. The bank has no upside. If the company does really, really well, they don't get any of that. So the definition of equity is whatever's left over, the difference between the assets and the liabilities. So if we make $1 million in cash, we still owe only $10,000 of bank debt. Our common equity is now worth $990,000. We all just made a ton of money. Right? What is that, like 50 times our money? So for every dollar you put in, you get $50 out. If you put in $1,000, you get back $50,000. That's upside. That's why people invest in equity. You also have the downside. What if, as an example, ePhone is only able to sell $10,000 worth of phones? Well, the bank, they still get made whole. They don't really care. They still get their principal. Let's call it $11,000, so they get their interest. Sorry, that's messy. The bank gets $11K, and we get nothing because there's nothing left. So there's a time and a place for both debt and equity, right? You might prefer to be an equity holder because you want that risk, you want that upside. You might want control of the company. You might want to say what strategic direction the company takes. You're not a manager, but you have say. You decide who the managers are. You can say, manager, if you don't perform well this year, we're going to fire you and hire someone new, right? So this is the fundamental accounting equation. Assets equal liabilities plus shareholders' equity, always. And this will always balance. This is an example of a statement of financial position. It's a bit dated, 2012, but a few things to point out. Statement of financial position at December 31st, 2012. Point in time. At that date specifically, New Year's, right? Total assets, notice how this is in thousands of dollars. So every one is 1,000, so that's 90 million. That's 90,000. So $90 million of assets, and lo and behold, the total liabilities and shareholders' equity are $90,000. What that says is these $90,000 of assets came from $90 million of assets came from $44 million of liabilities and $47 million of equity. One other thing to note, so these were some extreme examples here, but let's say ePhone has been in operations for a year. Let's say we did all right. We made $50,000 in profit. Let's say the company decides to keep that profit in the business. Let's say it wants to reinvest it, needs to buy inventory, wants to expand its warehouse, hire more people, whatever it might be. Who does that belong to? That's us as the equity holders. The profit that the company makes belongs to us. Even if it doesn't pay it out in cash as dividends, it might keep it in the business as cash, it might reinvest it in assets. But if the assets of the business increase, that belongs to us. The assets of the business decrease, that also gets attributed to us. So the third method or the third source of financing is what's called retained earnings. Earnings or net income or profit that has been retained in the business and not paid out to the equity holders. All right, what are some typical comprehensive income titles? Statement of comprehensive income, revenue and expense. Revenues might be sales, rent. Costs might be wages, rent, interest. Okay, we'll get into all of these. This is how an income statement looks, statement of comprehensive income. Notice how it's for the year ended December 31st, 2012. That is over a period of time. That is from January 1st, 2012 to December 31st, 2012. It is an accumulation. This is cumulative revenue and expenses earned and incurred throughout that period of time. We start with revenue, net sales, 152 million. Don't worry about all these line items, but notice how total expenses, $150,000. If I told you there's a business that had $150 million of revenue or $152 million of revenue, $150 million of expenses, what's the profit? You'd know, yeah, it's about $2 million. That's it. Notice how there's no balancing here, right? This is a net. It can be positive, negative, it can be zero, but there's no balancing here. It's not like the balance sheet, the statement of financial position, where assets have to equal liabilities plus equity. Okay, so this is a core accounting concept, and this is called accrual accounting, A-C-C-R-U-A-L, accrual accounting. And the theory here is that revenue is recognized in the period in which goods and services are sold, not necessarily when the cash is received. Think back to the example where I said, you said you made $50,000 this year, but you did a big job for someone, and you charged them $25,000, and they said they'll pay you in 6 months. You have earned that $25,000 of revenue because you sold your services, right? You did the work, and someone's going to pay you. Even if you don't get the cash until 6 months from now, you've still done the work, right? So here's an example. When will the revenue from this transaction be recognized? You make a sale for $1,000 on May 25th. You collect the cash on June 10th. In which month will that revenue be recorded? May. Okay? Doesn't matter that you don't get the cash till June. If I were to look at the balance sheet or the income statement as of May, I should see that $1,000 of revenue. Expenses. Notice how expenses are, okay, long-winded definition, the dollar amount of resources used by the entity to earn revenue. Used to earn revenue. And again, expenses are recognized the period in which the goods and services are used, not necessarily the period in which cash is paid. When you are an employee, does your employer pay you every hour? Do they deposit cash into your bank account every hour? No, it doesn't make sense. They pay you once every 2 weeks, once every month maybe. So after a week of working, have you earned revenue? Yes. Has your employer incurred an expense as the flip side? Yes. They have to pay you your salary. Just because they haven't paid in cash, it doesn't mean it hasn't been incurred. So if let's say you work a 2-week period that straddles the end of May and the beginning of June, at the end of May, the employer has incurred 1 week worth of salary expense, even though they haven't paid it to you, right? This example is, when will the expense for this transaction be recognized? You paid $75 cash on May 11th for a newspaper ad. No one really does newspaper ads anymore. And the ad appeared on June 8th. This is the reverse, whereby you haven't incurred the expense for that advertising until it gets shown. The newspaper has an obligation to show your ad on June 8th. If June 8th comes along and you check the paper and your ad wasn't there and the newspaper says, oh, sorry, we forgot to run it, we'll refund you your money, you never incurred an expense. Okay, so that's a bad example, and I blame the publisher for that. But anyway. All right, statement of changes in equity. So this is that statement that I said is not that important, but I want you to think of this almost like a bank account. Okay, just where you have a beginning balance, you have any money coming in, any work you've done, any OSAP, any investments you have, that's all money coming in, less what you spent is your ending balance. All of accounting works that way, right? That's very basic logic. Any balance works that way. It's the balance at the beginning of the period, plus anything that accumulated into that account, less anything that went out of that account is the ending balance, okay? So our equity, as an example, remember we put in $20,000 of equity to ePhone, right, collectively. That's at the beginning of the year. Let's say that's January 1st. Net earnings for the year, plus net earnings for the year. Remember how any money that the company earns belongs to us as owners. It doesn't belong to the bank. We're obliged to pay the bank, but if we earn $1 million or $0, the bank doesn't care. Don't worry about this. This is more advanced. Scribble that out. Not important. Less dividends. Dividends, remember how I said that's one of the ways to make money as an investor. Either your share can appreciate in value because people think that ePhone is doing well, or ePhone can say, we have some excess cash, we're going to pay it out to you guys as our owners. We're going to pay you each $100, okay? When that gets paid out in cash, that reduces the assets, right? Because our cash balance is declining. We now have less of a claim on the business, right? So our equity at the end of the period, so our equity at the end of the period, and then let's not worry about this, other changes. So we're going to go minus this and plus this is the ending balance. So we can really just think of it as what was our investment worth last year, what did the company earn, and how much dividends it paid out to us. That's what our equity is worth this year. Here's an example. Now, a couple things to note for the year ended. This is over a period of time, right? Similar to the statement of comprehensive income. Notice how we start with a beginning balance, January 1st, and then we end with an ending balance. So it should be December 31st. But notice how there's two columns, okay? Contributed capital, that is the amount of cash that was originally put into the business. When we initially funded the business, it had no operations, that $20,000 would be called contributed capital or common shares. Contributed because we gave it to the business. Capital is just the word for money. Retained earnings, that is the cumulative earnings of the business over time. At January 1st, the retained earnings of ePhone would be zero if it had no operations. But at the end of the year, it would have some retained earnings, hopefully, if it made money, if it made a profit. So they're broken out into two components. But the cumulative is, the total of that is going to be 46, 47. So notice how this is just a little breakout of that. Let me show you. So that's this section here. It just shows us a bit more detail, right? It's just how did we get from last year's balance to this year's balance? So remember what I said, the total of these is about 47. Guess it's million. So when we look on the statement of financial position, we see that this shareholder's equity is about 47 million. No coincidence. But notice here how we only have the ending balances. And that's because this is a point in time. It doesn't show us what the beginning balance was. We have to look at this statement to say, there's not much activity here, but okay, statement of cash flows. So again, this is different than the statement of comprehensive income because the statement of comprehensive income doesn't care when cash was received or paid. The statement of cash flows, that's all it cares about. So the interesting thing here is net earnings. So this is equals profit or what's called net income. Net income. Do not equal the change in cash from the period. If you were to say last year ePhone had $0 in its bank account and today it has $50,000 in its bank account, it's unlikely that the net earnings is $50,000. Why? Well, not only do you have the differences between revenues and expenses, but you also have ePhone spending cash on things. If ePhone spends $30,000 of cash on equipment, it hasn't earned any revenue, it hasn't incurred any expenses, so its cash balance is going to go down, but the statement of comprehensive income is going to show no impact, zero. So the statement of cash flows shows where the cash is moving. We aren't going to go into detail on this yet, but some things to note are it's over a period, right, for the year ended, and there's 3 sections. One is operating activities, and that is activities from our day-to-day operations. And that generated, net cash flow from operating activities generated $17 million of cash, $18 million. Investing activities, cash paid to purchase property, plant, and equipment, like machinery. And we paid about $1,500, $1.5 million for that. Financing activities, cash received from borrowings. This would be bank debt. Repayment of borrowings, we repaid bank debt. Cash paid for dividends, we paid this to our shareholders. Financing resulted in a net outflow of $14 million. Notice how it starts with cash at the beginning of the year. We had $571,000 of cash at the beginning of the year. And then we had a net increase in cash during the year of $3.2 million. Therefore, the cash at the end of the year is $3.7 million. If you went to our bank account, as at this date, you would see $3.7 million of cash. So this shows how we get there, right? And notice how that cash at the end of the year at the statement of financial position, 3727, that is the same number here. 3727, cash, right? Shows us how we got there. This is the ending balance. Okay, so here is the relationship amongst the statements. So you've seen the statement of financial position, statement of comprehensive income, statement of cash flows. You might have started to understand where the linkages are. Question? Oh, good question. On the statements, if you see a number in brackets, it means negative. So you're typically not going to see negatives on the statement of financial position, but you might see brackets in the other statements representing a decrease or a negative number. That's standard practice. Okay, so what is the relationships among the statements? So net earnings from the income statement or statement of comprehensive income, net earnings, results in an increase in the ending retained earnings on the statement of changes in equity. And then this goes to the balance sheet, right? If we make net income of $1.267 million, that goes to our statement of changes in equity, where we start with the beginning balance, plus the net income, what belongs to us as shareholders, less dividends paid, is the ending retained earnings. And that ending retained earnings from the statement of changes in equity flows to the statement of financial position. 28,681, 28,681. You can see how it moves, right? How it flows together. We saw this relationship already, but from the statement of cash flows, what you see is the ending cash balance. That's going to be on the statement of financial position as the total cash we have. This just shows you how you got there. If you were an investor and Google said, yeah, we have $5,000 of cash, you said, but I thought you guys earned $100 million this year. Where did all that cash go? And they said, we don't know. You'd probably be pretty upset, right? You want to know where the cash was spent. All right, notes to the financial statements. So what does that mean? So when you receive financial statements, really they're, and I'm not exaggerating, for the biggest companies in the world, there's still 3 pages. There's going to be your statement of financial position, your statement of comprehensive income, and your statement of cash flows, and that's it. 3 pages to summarize global business operations worth $100 billion. These statements do have a lot of detail, but it's all numbers, right? It's all cash, $1 million. Revenue, $1 billion. You might want to know a bit more about the operations. There is a standard way of doing it to disclose this information, and it's called notes. Notes are official prescribed ways of describing the balances. So the cash balance, you might wonder how they report that cash balance, and there'll be a page after the financial statements that just discuss cash. And there'll be a page after that that just discuss revenues. The notes to the financial statements can be 50, 60, 100 pages to describe the numbers you're seeing. Okay? We won't go into the notes because it's too much for a course like this, but it describes the accounting rules. It presents additional detail about items on the financial statements, and it provides information about items not on the financial statements. So if something is excluded from the financial statements, but the accountant thinks it's still worthwhile for you to know about it, it'll be in the notes. In fact, reading the notes is more important than actually looking at the financial statements, but reading the notes is honestly like another language because it's all jargon. You really have to understand accounting first before you can get to the notes. Okay, so this is nothing new. What are some management uses of financial statements? And so this will be the people who run the day-to-day business, right? A credit manager. What is a credit manager? What does it mean to extend credit? So think of if we're ePhone and we need to buy cases and microchips before we can start making our phones, but we have no money. So we say to the supplier, can you give us the cases and microchips now and we'll pay you in 6 months? Someone at the business has to say, sure, we'll send you these goods and expect payment in 6 months, but they might go bankrupt, they might not pay you. We don't have any history of operations. How do they know we're not just going to take those cases and microchips and sell them on the black market and run away with the money, right? So there's a credit manager, someone who decides whether or not to extend credit, meaning we'll ship you these goods on good faith and hope that you'll pay us back in 6 months, right? Someone needs to make that decision. A purchasing manager uses suppliers' financial statements to decide whether suppliers have the resources to meet demand for products. So if I'm going to sign a supply contract with someone to provide me with 100,000 cases, and I'm going to pay you up front, and I go and I say, wait a minute, you only have one factory, and that factory has a capacity of only 40,000 cases. How are you guys going to build the other 60,000? That might be a cause for concern, right? You might also care about how much inventory you have on hand. We discussed this earlier. You might need to make sure that you have 100,000 cases on hand because you have 100,000 of every other piece, and you have an order for 100,000 phones. So you need to get those 100,000 phones out, right? Okay, accounting, responsibilities for the accounting communication process. Remember I said accounting is a language, okay? What does it mean to have effective communication? It means that the recipient, and this is a very abstract concept, the recipient understands what the sender intends to convey. Okay, so Google wants to send a message with its financial statements, and it hopes that the investors understand what it's saying, right? It doesn't want to be ambiguous. If you're a decision maker, if you're an investor, you need to understand how accounting works. Right? You could not pick up a set of financial statements and understand what they say without taking this course, or maybe a few other courses. Right? So you need to understand how to read this, because it is a different language. Okay, so can you foresee a problem if Google, Microsoft, Amazon, Apple, and ePhone all just decided to report numbers how they wanted to report them? They might have their own incentives. They might say, we want our stock price to be really high, so we're going to report really good profit, even though we didn't really earn a lot of money. Or we're not going to disclose this debt, even though we owe the money to the bank. That'd be a problem, right? Because how would you as an investor make any decisions if A, they're lying to you, or if B, they're inconsistent? What if your decision was, do I want to invest in Google or Amazon? I can only pick one. Well, you're going to need to pick up both their sets of financial statements as a starting point and say, which one do I think is going to make more money in the future? Which one's going to be more profitable? You can't compare the two if they're not reporting on the same basis. If Amazon reports its revenue based on the amount of cash it collects, and Google reports its revenue based on the accrual basis, based on when the service is provided, you might say, oh, Google has way more revenue than Amazon. But Amazon might have actually earned more revenue, it just didn't report it, or vice versa. You start to run into comparability problems, right? So there need to be rules so that everybody's on the same page, so that I So I'm an accountant. I should be able to pick up a set of financial statements. I don't need to know who the accountants were. I don't need to know what the company was. I don't need to have gone and talked to the management of the company. I should be able to pick up the set of financial statements and understand exactly what it says. That's the expectation with financial statements. They're very standardized. So what are the rules of standardization? IFRS, International Financial Reporting Standards. As you can tell by the name, international, they've been adopted by the vast majority of developed countries, with the exception of the US, who uses their own accounting system, which is slightly different. But any set of financial statements prepared under IFRS will look the same. Meaning you don't need to have any understanding of the business beforehand. You don't need to know the accountant. You don't need to have gone and seen the company in person. You can pick up the set of financial statements and understand exactly what it says. Think of it from, in math, maybe standard notation, right? The way you would write derivative for or a function for a derivative. There's standard notation, right? Think of science. There's standard notation for the periodic table. Right? There's a reason why these things are standardized, so that everyone can understand them. So IFRS is kind of the rules of the road. IFRS ensure that financial statements can be prepared consistently. Consistency is key. Why? Because users of financial statements, us as investors and the bank as a creditor, they need to be able to compare a company across time. So you care how the company has done over the last 3 years. If they change their accounting standards every year, how can you compare? You need the same basis of measurement across time, but also other companies at the same time. So you want to know, over time, how has Google performed? Revenue growth, profit decline, increase in debt, increase in cash, whatever it might be. We also want to know, how are all these companies doing today? How does Google compare to Amazon, compare to Facebook, compare to Apple today? It's like driving without road signs or speed limits or lane markers or street lights, or speaking English without rules of grammar or syntax, right? It'd be very hard to communicate without these rules. So accounting actually is not a new invention. Accounting as we have it today was invented by the Italians in 1500. And we'll get into what double entry means. Okay. But even for, 439 years, management teams of most companies were largely free to choose their own financial reporting practices. Now, as an aside, how do you think, so we're investors and we want to hire a manager who's going to work hard, make money for us, right? How do we align a manager's interests with our interests? We want the company to be profitable. We say to the manager, make us more money. We have to give them an incentive. We'll say, if the company makes $1 million of profit, you get a bonus. Okay, we're going to give you $100,000 of that. Manager's going to work really, really hard, right? Now, if the manager is also a smart accountant, at the end of the year, if he realizes he's only at $900,000 of profit and he's not going to hit the target, he might just start making some accounting entries, and all of a sudden the business made an extra $100,000, right? Think about investors. What if the company says, okay, well, what if we're ePhone and we've expanded or we've grown and we know that we need to buy a new warehouse? These are expensive. Let's say the warehouse is going to cost us $1 million. And we know we're going to need this next year. And the bank won't give us any more money. We don't have enough cash. So we're going to go to the investors and we're going to say, give us more money. We'll give you more shares. If you're an investor deciding whether or not to give ePhone the marginal $1 million, you're going to say, well, let me see your accounting statements. How much money did you make last year? Is this money just good money after bad? Is it going to go nowhere? So if you know that you're going to be trying to raise money, raise capital in the stock market next year, you have an incentive to make your books look really, really good, right? So think of the problems that arise, not to mention the fact that you can't compare two companies across between each other or across time if management just chooses their own financial reporting practices. There has to be a standard framework, right? Not only that, they have to be audited by a third party. Have you guys heard of KPMG, Ernst & Young, PricewaterhouseCoopers, Deloitte? These are the four, they're called the Big Four public accounting firms, and they are auditors. So they will audit these companies, Google, Facebook, Amazon, and say, you're not lying on your financial statements. They'll say, yep, your revenue is accurately reported, your bank debt is accurately reported, your cash is true. They'll go and check all these numbers because investors don't trust the company, right? The company has all these incentives to make their numbers look better than they are. So an audit will be done by an independent third party to say, yeah, these numbers are true. And those audits will adhere to the accounting standards, to IFRS. So the Securities Act of 1933 and the Securities Exchange Act of 1934 have given, have you guys heard of the Securities and Exchange Commission? They are the governing body in the States for all stocks, right? So the Securities and Exchange Commission says if you're Google and you want to be able to access the public markets, if you want to be able to go issue shares to the public, you have to comply with our rules. And it's regulation. It's to protect investors like us. If Google was private, meaning they couldn't issue shares to the public, where do they get money from? Debt, or they'd have to self-finance. They'd have to earn money, then reinvest it, then earn more money, then reinvest it. It would take a very long time, right? A lot of companies find it very advantageous to be what's called public. Public meaning you and I can go out and buy a share of them right now on Questrade or on any broker platform, right? But to be publicly listed, you have to go through a lot of regulation. You have to adhere to a lot of rules and laws. So in the States, that's set by the SEC. And the SEC also is responsible for measurement rules for financial statements in the US. Ontario has something similar called the Ontario Securities Commission. And they've also been given, and so they do the same thing. They regulate the publicly listed stocks. If we're ePhone and we need money and we're not publicly listed and the bank won't give us money, we're out of luck. Where else are we going to go? Who's going to give us money? Private investors maybe, but that takes a long time and it's hard to do. So we want to comply with the OSC's rules, and the OSC says, here's how you have to report your financial statements. Okay, so GAAP, not the clothing company, generally accepted accounting principles. That's sort of shorthand for what are the rules. So the OSC has worked closely with the accounting profession, with all the chartered accountants in Ontario, to say what are the best rules for companies. Just last few slides, bear with me. Key takeaways. There's a lot of information here. A lot of it is abstract, I appreciate. These are the fundamentals. We will build on this. You will come to understand this, hopefully, as basic and simple and the underlying foundation of accounting. But there are 4 financial statements, 3 of which I care about much more than the 4th. Remember, this statement and changes of equity is not that important. Statement of financial position is at a point in time. Statement of comprehensive income is over time. Statement of cash flows is across a period of time. Assets, I'm going to put a star beside this. This is very important. In fact, I might even ask a midterm question about this. Assets equals liabilities plus owner's equity, shareholder's equity, always. And we'll get into the mechanics very soon. Next class, we're getting into accounting mechanics, how you actually build up these balances, and you'll see that this always holds true. The 4 statements are interconnected. Remember how we saw that the balance from the statement of cash flows goes to the statement of financial position. The net income goes to retained earnings, and retained earnings is part of the shareholder's equity in the statement of financial position. So they're all connected. Who are investors? They provide a business with cash, and they're owners. They're owners meaning they have control, and they have upside but also downside. They have risk. The business does well, they do well. Owners can gain through selling their shares to someone else. We might go to the Econ 101 class around the corner and say, hey, do you want to buy our shares of ePhone? It's doing really well. Even though we paid $1,000 for them, we might get the econ class to pay us $1,300 a share for them, right? We just made money, $300 a share. Or if ePhone generates a lot of cash and it doesn't need all that cash, it'll pay it back out to us, and we just earn more money on our initial investment of $1,000. Creditors also provide, so creditors might be the bank. Creditors provide businesses with cash but are not owners. Okay, they don't share in the upside. They don't have say in the strategic direction of the company. But they get paid first. That's the most important thing. If the business does poorly, they don't care. We owe them their interest and principal. If the business goes bankrupt, we have to liquidate our assets and pay them first. Creditors gain through receiving interest income. Interest income on the principal lent to the company. Creditors are external. We are, as shareholders, external. Managers are people we hire to run the business, right? We have a say in who runs our business, and if we're actuaries and biologists and kinesiologists and accountants, we don't want to be running this business. We have our own jobs to attend to, but we want to put away our money and invest it. We want someone competent to do that for us. Managers will use internal accounting information, which is different than the type of information we care about as investors. So managers are considered internal users. And that's it. Okay, thank you everybody. 9 o'clock, we finished a little bit early. Thank you.